if you look at those four factors, will it give you 100% guidance on what's going to happen with the gold price? Absolutely not. But will it give you a strong feel for where it's going? I think it does.
Hello, trader friends. Welcome back with me. And Simon Popple is back by popular demand, director of the gold program.
Great to be here.
Scare you off the last time.
No. Well, gold is continuing to fly, so still very topical.
Yeah, it is. And I mean, just whacking up the chart, trader friends, this is what we are talking about here. It is still shining there, as you can see. We've seen a bit of consolidation recently, but it has broken past that 3,300 level and approaching the second area of interest. You see my rectangles there, Simon. I like to draw that for our trader friends because they understand where the support and resistance lies, where the interest lies. And if we break through the second rectangle where my cursor is, we could then move towards highs last seen in May. But the key question here is the big, beautiful bill. We talked about this earlier. If it passes, you know, what is clearly we're going to see more spending, obviously, and this is expected to boost prices. But what if we get a watered down version?
Yeah, I mean, I think that, first of all, the US is a massive driver of the gold price. Whatever happens in the US seems to determine, what happens to the price. And the bill will certainly, I think, spending will go up, and some of that will feed into spending on gold. But I think you need to look at the sort of the key drivers of the gold price. The MIDI we discussed last time of market uncertainty, inflation, debt, and interest rates. And I think all four of those are working in gold's favour. So obviously we don't know what's going to happen, but I think the price is more likely to go up than down.
You talk a lot about MIDI, don't you? Trader friends, we've talked about this the first time he was here. These are the levers. Lots of people go, so many things. There's so many factors to think about when trading gold. But we like to keep things simple here. So you've got an acronym that's really interesting. Just run us through this.
Yeah, no, sure.
MIDI.
I mean, MIDI is just trying to keep things really simple. As you rightly point out, there's lots of levers of the gold price, but MIDI, if you look at, again, look at the US, but market uncertainty, inflation, debt, interest rates. So if you look at those four factors, if they are in favor of a higher gold price, so more market uncertainty, like, the tariffs, no one knows what's going to happen there. Inflation, that goes up. Debt, I haven't heard a single argument as to why that's going to come down anytime soon. And interest rates, which is an interesting one because on the one hand, there's pressure to bring them down, but if inflation's going up, it's quite difficult to bring them down. But I think that if you look at those four factors, will it give you 100% guidance on what's going to happen with the gold price? Absolutely not. But will it give you a strong feel for where it's going? I think it does.
Yeah.
And so...
And that strong feel, especially when you talk about debt. Let's whack up my chart right now. It's no surprise there. Take a look at this clock that we often watch on the left-hand side here. I mean, there's no sense, no mood music that suggests this is coming down anytime soon, right?
Yeah, and absolutely. And I think it's one of those things where, debt will continue to go up. And I've got a chart on my website that shows that over the longer term, as debt goes up, the gold price goes up. And, it's a pretty simple relationship.
Yeah.
So if something happens where suddenly the US debt comes down, then, I think that's certainly something we need to look at. But I haven't heard any credible argument for why the debt will come down. So
yeah. And if this bill goes through, it's another $3.8 trillion to the federal debt that's expected to be added over the next decade.
Well, exactly. And on the one hand, it's great that they'll be spending more on various things, but unfortunately, it's paid for by debt and not taxes. So higher debt I think good chance it could lead to a higher gold price.
So let's take a look at the price of gold. A lot of people saying, "Hey, Ange, it's had such incredible returns, right? We've seen gold prices gain a huge amount over the last few years. I mean, since 2000, the figure you like to always sort of talk about is in British pounds. What is it, 10%?
It's over 10.6% per year since 2000. So for over 25 years, the gold price has gone up on average over 10.6% a year, which is, it's pretty good.
Lots of people going, well, is it too late? Is it too late to jump in now? Have all the gains been had? I kind of think, in my humble opinion, with all these factors still in the pot, still in the mix, it's not too late just yet. What's your view on this?
No, I agree with you. I mean, I think 2 points. First of all, look at MIDI. Is market uncertainty coming down? No. Inflation.
Yeah, it's
debt,
still going up.
Interest rates, you know what I mean?
Yeah.
If you look at my website, the gold program, I've got a tab on gold price projections, and this is really looking at history, and looks at some forecasts done by Incrementum. And I think that first of all, they've shown they're pretty good at forecasting, and secondly, they've given an idea as to where the gold price will go. And I think that could be really exciting. So no, I don't think we've seen anything like the top of gold.
Let's talk about some of the ways to get in. So let's say you're sitting there, with a cup of coffee, and you're saying, okay, well, I'm really interested, and I would like to get in if you haven't already. I made this special chart for you to try and illustrate different ways that you could gain exposure to gold. So let's take us through it, Simon. Let's start on the top.
Yeah, I mean, I think you start off with physical gold.
Yeah.
I think that's the lowest risk. Incredibly liquid. If you want to sell your gold, you can sell it. Pick up the phone with your dealer and sell it straight away. Probably get cash in your account within a few days. So very liquid. It's also tangible. There's, as you say, tax advantages on coins. Yes, it's wearable. The storage and insurance costs, yes, you do have to pay them, but I think it's very important to realise that you don't have to take delivery, so you can get the people you buy it from to store and insure it for you.
Yeah.
Yes, there's a cost, but
so if it's like the Royal Mint, you just pay them to...
You just pay them
storage and insurance.
A monthly fee.
Yeah.
It's not much. I don't know what it is exactly, but it's probably not dissimilar to an annual management fee that you would pay a fund manager to store and insure it for you.
And gold ETFs. I mean, we've got lots and lots of trader friends here that look at gold ETFs and indeed buy them. This is easy trading, low fees, no storage hassle. What are the downsides?
Well, I think gold ETFs, I think they're a very good short-term home for money. But you have to remember that there's often limitations on what you can actually redeem them for. So you redeem them as cash rather than gold. And quite often the ETF is actually backed by, well, it's derivative driven. So the uplift is in your investment is basically down to derivatives. And so if you're trying to move away from derivatives because you're concerned about the financial system, then it doesn't make much sense to invest in something which you're actually trying to move away from.
The point that I keep facing when I look at a gold ETF is you're essentially paying a middle person to gain exposure. Is that your view as well?
Yeah, I mean, some vehicles, they say, oh, we're backed by gold.
Yeah.
And, if they say, oh, we're backed by gold, my take on it would be, well, why don't you buy the gold anyway and have it, under your name rather than their name? because then you can, you set your own rules, redemptions and things like that. And also, if there's cost to be incurred by storing and insuring it, they will have to pay it, and therefore you will have to pay it. So by investing in that type of vehicle, you might dilute those fees a little bit, but personally, I'd rather have the control of the gold. And while we're talking about that, another thing I like about gold is it's divisible. Compared to, let's say, a property where it probably costs, let's say, 300,000, 400,000 pounds. If you only need 20,000, you don't want to have to sell a 400,000 pound property to get 20,000 pounds. You can't just sell the spare bedroom. And whereas with gold, if you need 20,000 pounds, you could just sell one bar, a few coins, whatever it is. And you've got your money, and you've got the rest of it still invested.
Right. Andrew McKilvey is saying, and not gold that's gone up, it's the pound that's gone down because our government, and not just our government really, keeps printing money, keeps the rollers going. What's your view on that, Simon?
Andrew's absolutely spot on. It's
we talked about this earlier, didn't we?
Yeah.
It's like at every single point, whether it's great financial crisis, it's COVID or whatever, we just print money, print cash, helicopter cash, steal from the future.
Well, that's it. I mean, you mentioned the bill earlier about, the US printing loads of money for this wonderful bill, but that's printing money. And so gold stays the same, the dollar goes down in value. And I think that's, that's incredibly valid. And one of the reasons why I like gold, because you can't print it.
And that dovetails beautifully. We didn't plan this, I promise you, to my next chart, which I wanted to show you. You have that gray line, which is the dollar, and we have that red line there, which is gold. And look at that, beautiful contrast there, because really one of the things that's supporting gold, in my humble opinion, is this de-dollarization. Right, back to investing though. Some other ways, we talked about ETFs, we talked about, like the iShares Physical Gold, ETC, Invesco Physical Gold as well, another popular one. But let's take a look at perhaps gold miners. What do you think of, trading the gold miners as a way to get into gold?
I think it's great. I think, once you've got your physical gold and ETF or funds, whatever you like, then I use a fantasy football format to explain the companies, where a goalkeeper is a very large barrack type organization. Then you've got defenders, which are sort of smaller but still very large companies. Midfielders are new to production, and forwards are your explorers. And obviously depending on sort of your level of risk, but I think that you want to have a goalkeeper. You then want to decide how attacking or defensive you want to be. So decide how many defenders you have, how many midfielders you have, how many forwards you have. But I think by doing that, what you do is you get exposure to the sector, but from a variety of different companies. So you don't have all your money on one particular company.
All your eggs in one basket.
Exactly. And I think the other thing is a lot of gold miners, they not only are involved in gold, but they're involved in other commodities as well, where copper or silver or zinc or whatever it is. And so by having a diversified portfolio, you're also diversifying in different commodities as well.
I always say that if you are invested in gold mining stocks, be aware that there is higher risk depending on where these miners are, right? And that risk comes from, if it's, remember that Resolute Mining story when its executives were detained in Mali?
Yeah.
All that has an impact on the share price, which could cause very, very heightened volatility. Simon, would you say you prefer mining stocks that are, in safer or relatively safer geographical, political landscapes?
Yeah, I mean, I there's plenty of companies in Canada, US, and Australia So if you're going to invest in the sector, then you can get plenty of exposure just by investing in those countries. And not only do you get the country diversification, you get the currency diversification as well. So you're not, let's say, just in sterling. You've got some Canadian dollars, US dollars, and Australian dollars, and obviously you've got commodity exposure as well. So you're diversified on a number of different levels. If you've got a company which is in Australia, Canada, or the US, then I like it.
Yeah, I am bullish on Greatland Gold, and they've been doing very fine things. Thank you very much. Andrew was the one that highlighted Greatland Gold to me in the first place.
9% today, pretty good.
Julian's message there, am I correct in thinking you don't just print money, you have to borrow it into existence?
Well, yeah, I mean, but if you're a government, then you own the credit card.
Yes.
And so, you don't have a limit. You just print as much money as you want.
Yeah.
And I think that's the rub.
Yes, and that's a run with the governments as well, and that is why we're in that sticky mess that we're in right now. And we're seeing the bond vigilantes as well. Very quickly, digital gold, pros, fractional buying, convenience, but the downside, fees and no physical possession. Do you like digital gold?
I prefer physical gold. I think that digital gold is a combination of crypto and gold.
Yeah.
And I think if you want crypto, you buy crypto. If you want gold, you buy gold. And I wouldn't want to have a product that kind of has both. I'd buy either or.
Let's just have a look at, some of the digital gold providers. There are quite a few there. But back to our, I know we don't have much time left. Royal Mint trading is another way, right? We talked about Royal Mint earlier. This is a trusted name. You got that, Simon talked about the secure storage option as well. But, I guess I want to end with, what is your preferred method? Given we have different durations there, different traders with different durations there. Give us a short-term play. So, for example, this week or next week, or if you have a medium-term way, if someone said, I want to be in the market for 3 to 5 years, and a longer-term way to get in.
Yeah, I mean, I would say short-term, I would probably say, within 12 months. No harm in having ETF. If you've got a very short-term view. A lot depends on how much money you're putting in, obviously. More of a medium to long-term, I'd say physical gold.
Is this 3 to 5 years?
Yeah, 3 to 5. Yeah, well, I'd say medium-term, 1 to 5 years. I'd have physical gold, and over the medium term, I'd also look at companies. A lot depends on where you are on the risk profile, but I think that. Physical gold, I love it because it's so liquid, and if you want to sell it, bang,
yeah,
you sell it now.
And you can sell it in chunks as well.
Exactly, and if there's a market crash, that's obviously going to affect your equities. It could affect ETFs depending on what's in them. But if you've got physical gold, it's an asset class in itself. I buy mine from the Pure Gold Company. There are plenty of places. I think all I'd say is you want to do due diligence. We've mentioned the Royal Mint. You can buy gold from Royal Mint. You can buy places like Bullion by Post. And a lot depends on how much you want to buy, because, if you just want to buy a couple of coins and something like Bullion by Post, even though it says by post, you don't have to get it posted to you. You can, you can buy it and store it. If you want to buy a bit more, Pure Gold Company I like, and then you've got people like Degussa, there's lots of places, but make sure that they are do your due diligence, make sure they're bona fide, make sure they've got. The company I use are affiliated to the LBMA, and they're a distributor for the Royal Mint, and so you want to make sure that they fit the profile you're looking for.